Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Olokobe Kwedemi by name, the accounting tutor, and we'll be treating companies' accounts right now. And we have our outline. We have the definition of a company. We're going to look at the kinds of company, types of companies. We're going to look at the formation of a company. And we're going to look at the share capital. Then we're going to look at the accounts of a limited company. Now we're going to look at the definition of a company. Generally, a company has been defined in the various ways based on the number of authors and scholars we have on the field. So generally, a company has been defined as a legal entity. That is, a legal entity formed by two or more persons to carry on a business with the common purpose of making a profit. So whenever a company is being formed, the company became a legal entity, that is a distinctive entity on its own. So once a company is formed, so a company becomes a legal entity, that is a distinctive entity on its own, an entity that is different from the owner. So once it is formed, it's what is registered by law, so it can carry on a business, and the purpose of it carrying on a business is to determine how to make profits for its owners. Okay, we have the next thing. We have the kinds of company. Generally, we have three kinds of company. We have firstly, we have unlimited company. The next, we have limited. We have company limited. Company limited by shares, and also we have company limited by guarantee. Now we're going to talk about the unlimited company. The unlimited company, as I've been stated out, unlimited. This category of company, the liabilities of its owner is unlimited. That means if the business should run down, or in case of liquidation, that is coming to an end of the business, what will happen if the capital of its owner is unable to meet the debt of the company? That means the owner will be forced to use his private property in meeting up the debt of the company. So it means unlimited liability company and unlimited liability company, the capital of its owner is unlimited. That is, the liability of its owner is unlimited. It is not limited to capital or contribute to the business only. It's also unlimited to its private property. So in an unlimited liability company, the liability of its owner is unlimited. It's having unlimited liability. So in case of running down the business, if the debt of its owner if the capital of its owner cannot be able to meet the debt, what will happen? The owner will be forced to use his private properties or his estate in paying up the debt of the company. So now we also have company limited by shares. In company limited by shares, the liability of the company is limited by the number of shares owned by its owners. If the company is to be liquidated, what will happen? What the owners will only use in the business is the number of shares they own in the company. That means if the number of shares of the company is unable to meet its liabilities in case of insolvency, what will happen? The owner does not have to lose his private property, since the business is a legal entity, the distinctive personality on its own. So in the limited liability company, the owner is always different from the company. So the liability of an owner in a company limited by shares is limited. The liability is limited to the number of shares owned by its owner. So the owner cannot lose his estate or his property when the business is to be liquidated. So the next thing we have is company limited by guarantee. The company limited by guarantee, the company is not formed for the purpose of making profit, or is formed. This category of company is usually formed for social or religious purposes, and this form of company is usually formed to satisfy the interest of its member. So once this such company is being formed, what will happen? The liability of its member will be limited to the number of shares they contribute to the company. So it means the liability of its member will not extend to his private property or his estate. So do not forget, company limited by guarantee they are usually formed for social, religion, or educational purposes in order to satisfy the interest of its member. That is the reason why company limited by shares is different from the company limited by guarantee, because the former is actually formed for the purpose of making profits for its shareholders, while the latter is formed for the purpose of what? Satisfying the interest of its member, not for profit-making purposes. So it means in both companies, whether limited by shares or limited by guarantee, the liability of its member is always limited by the number of shares owned by members and does not extend to their private property or to their estate. So the next thing we'll be looking at is the formation of a company. How is a company being formed? I'm going to look at the step in the formation of a company. If you have to own your company, what are the steps you have to follow? We'll be looking at that now. Okay, the first step in the formation of a company is to seek the service of a promoter. That is, seek the service of a promoter. So it is promoter that will determine the formation of the company. You're going to determine the capitalization of the company, the amount of capital that will be acquired by the company, all the assets that will be acquired by the company, and also the promoter will be the one to file the necessary documents that will be required by the company. And this document that is required by the company these documents are: number one, we have the memorandum of association. And number two, we have articles of association. Number three, we have prospectus. Yeah, I think so. Yeah. Prospectus. And number four, we have certificate of incorporation. So these are the documents in which the promoter will help the company, that will help the company that will fight in the establishment of the company. So these documents are necessary in the establishment of a company. So we have the memorandum of association, we have the articles of association, we have the prospectus, and we have the certificate of incorporation. Now let's begin with the memorandum of association. This is an important document in the process of establishment of the company. So this document usually shows the relationship between the company and the outside world. That is, shows the responsibility of the company as it regards with the outside world. How is the company to relate with the outside world? So it shows the regulations, it regulates the power of the company with the outside world. It gives the laws, the rules, and the principle of the company with the outside world. How is the company going to relate with the outside world? So what does the memorandum of association contain as a document? It contains the objective of the company. That is, a company that is to be established must have a certain objective. So its objective must be fully stated. So number two, the name of the company must be fully stated. And number three, the purpose of establishing of the company must be fully known, because such a company must not be formed for an illegal purposes. So the purpose of establishing such a company must be fully known by the public. And number four, the number of authorized share capital must be fully stated. That is, the registered capital must be fully stated. So the document shows that is the registered capital of the company, that is the authorized capital of the company. So let's talk about that briefly. We have a lot of this thing that is contained in the memorandum of association, so I will advise you can read more about that. So we have the articles of association. So in as much as the memorandum of association gave the responsibility of the company with the outside world, the articles of association deals with the relation of the company the internal relationship of the company. It helps to regulate the internal relationship of the company. That is how the company is being run and the management of the company. So it shows the internal relationship, while this shows the external relationship, the relation of the company with the outside world. So this one shows the internal relationship of the company. It helps to regulate, that is the auditors, the management, and the board of directors. So what is contained in the articles of association is the number of it contains how the directors are to be appointed, the rules that guide the appointment of the directors, and it also tells us, okay, what are the responsibility of the board and the responsibility of the directors in the business. So it also tells us how are we to call up capital within a period, and how are we to forfeit shares within a period. So it also gives the power, of directors in the business, how a director are appointed, and so on and so forth. So it helps to regulate the internal responsibility of the company. So that is articles of association. We have more of things that is contained in the articles of association. So take a textbook or take another form of sources, a very reliable sources, so read more about the articles of association. Now the next thing we have is the prospectus. These prospectus will also be paid by the promoter. This serves as a what? As an advertisement. It serves as an advertisement in the to the public, in order to invite the public to buy the shares of the company. So what will happen? The public will be what? Will be invited, and that the company will be invited in form of a prospectus to another what? In order to buy the shares of the company. So whenever a company is to be formed, that will require large capital, and for the company to meet its objective of meeting this capitalization, what will happen? The shares will be sold to the public, and if the shares will be sold to the public have to be invited. And how can the public be invited? The public can only be invited through the prospectus. So this document is just like an advertisement in inviting the public to buy in the shares of the company. So the next thing we have is the certificate of incorporation. The certificate of incorporation, you have that of self. Once the company has received the certificate, this serves as the final stage for most companies, especially the private limited liability company. So once the company has received the certificate of incorporation, it means the company is fully registered, and that means the company can carry on a business. So the certificate of incorporation serves as the power given by the register of a company, that the company has fully met the required regulations in the establishment process of the company. So then the certificate or the document give power to the company to carry on a business. So once the certificate of incorporation has been given to the company, it means the company has been given power to carry on a business. So it is the final stage in the establishment of the company. So, and the document shows that the company have fully met all the required steps and processes required for its establishment. So let's talk about the types of companies. In NECO, we jump into types of company. Generally, we have two types of company, especially company limited by shares. That is two types of companies limited by shares. We have the private companies, private limited liability company or private companies, and the public companies, public limited liability companies. Now, the private company or private limited liability company is entirely different from public limited liability company or public companies. When talking about the private limited liability company, these companies are usually formed, for the purpose of carrying on a business, and the number of shareholders have in such a company is the minimum number of shareholders we have in the company is 2, and the maximum is usually 50. When talking about the private limited liability companies, the public are not usually invited in the establishment or in the buying the shares of the company. No. The public are not invited to buy any form of shares in the company. The public are usually restricted in the buying in the purchase of the business of the shares of the company. And again, when talking about the private complaints, what actually usually distinguishes them from a public company is due to the fact that the shares are not usually transferred. That is, the shares cannot be transferred from one shareholder to another without the knowledge of other shareholders. Someone cannot transfer shares to any other person without the consent of other shareholders. So the other shareholders must be fully known. They must be known about they must be know about the transfer of the shares. So whenever shares have to transfer, the other shareholders must have the knowledge of such a transfer of the shares. So we have the public company or public limited companies. So in this company, the number of shareholders we have there is the minimum is 7, while the maximum is not prescribed. So we can't know the maximum number, or there's no maximum number of shareholders in the company. That is, number of shareholders is infinity in the company. And again, in this company, the public are usually invited to subscribe in the buying of the shares of the company. So the member of the public are allowed to buy in the shares or to contribute their quotas in the establishment of the company. So while also in this company, that is public limited liability company, shares can easily be transferred from one person to another. There is transferability of shares in the company. While also in the public limited liability company, public limited liability company is usually end with word PLC. So they are allowed to use the word PLC, that is public limited liability company, with its name. Like we have Zenith Bank PLC and so on and so forth like that. So they are allowed to use the word PLC in their name. Why private limited liability company are allowed to use the word limited in their name. So the next thing we'll be looking at is the share capital of a company. Okay, we have share capital. We have different type of share capital in a limited company. Number one, we have authorized. We have authorized capital or nominal capital. It can also be called the registered capital. So we will also be looking at issued capital. We'll be looking at issued capital. Also, we'll be looking at called up capital. Okay, called up. We'll be looking at uncalled up capital. We'll be looking at paid up capital. So now on this work, so I also have unissued capital. So what we'll be talking about unissued capital. So the first thing we have here is the authorized or nominal or registered capital. As stated earlier in the memorandum of association, I said the document contains the authorized or the registered capital of the company. So that would, such capital will be stated in the memorandum of association. That is, this capital represents the total amount of shares that will be available for the establishment of the company. It serves as the capitalization of the company. So this is the maximum number of shares that the company is allowed by the memorandum of association to issue out to the public for what? For raising of capital. So this represents the maximum number of shares issued out. That is the reason why it's called the nominal capital. It's been nominated by the memorandum of association, so it cannot be more than the shares. That will be the maximum that the company is allowed to raise from the public. We can also add that is why I also call the registered capital. So this capital is registered with the memorandum of association and is authorized by the memorandum of association. So there is any form of capital. If the capital is not up to in financing the project of the company can issue the debentures and can seek for loans to meet its project. So the next thing we have is the issued capital. The issued capital is part of the authorized capital. so issued out for the public for subscription. This type of capital is actually the part of the capital that is the nominal capital that is beginning of the company, which the company can issue that to public for subscription. If company can desire to issue all of it authorized capital, so the part of the authorized capital issued out to the public is now called the issued capital. The company can decide to issue all of it authorized capital, or they can issue parts. So it is a part of the word authorized capital issued out to the public for subscription. So the next thing we have is the code of capital. So it's the part of the issued capital called up by member of the word of the public. So any form of the issued capital that is available for subscription by the public, any part of it called up by what by the shareholders or by the public is now become a called up capital, and the shareholder will be required to pay for such share that is being called up. So the issue capital can actually equal to what call up capital. So when it means when the member of the public call up all of the issued capital available to them. And the next one we have if honest part of it is that the call up capital can even be more than the issued capital. That is, the shares actually called up by the member of the public is more than the availability of shares. It's more than the number of shares available to them. That is more than the shares issued out by the public. So that will be the responsibility of the companies to know how they are going to allocate these shares to the public. So the next one we have is the uncalled capital. This also forms the part of the word issued capital that has not been called up by the member of the public. So the next thing we have here is the paid up capital. This is the part of the called up capital that has actually been called up by the member of the public, and the public has actually paid for it. So when the member of the public call up for the particular shares and they paid for the shares, that shares become a paid up capital. Now the next thing we have is the unissued capital. This also forms the part of the authorized capital. The company fails to issue out for subscription to the public. The company might have a lot of reason for that. They might not to what issued such capital out to the public due to some certain reason. So that also forms part of the authorized capital, or the nominal capital, or the registered capital, so that the company has failed to issue out to the public. Accounts of a limited company. So a limited company is going to prepare the following accounts. Number one, we have trading profits and loss accounts. That is to determine the profits, that is the net profit or loss during the period. Now the next one is to prepare the appropriation account, just like the partnership appropriation account. And the third one is to prepare the statement of financial position, which is the balance sheet. So the appropriation account, the company is going to prepare the appropriation account. You have to determine the form of reserves, that is dividend given to shareholders, that is dividend that will be what will be proposed to the shareholders, and also whether there will be any form of retained profit during the period, or there will be any form of what capital reserve or revenue reserve during the period. Okay, now we have the balance sheet. So the balance sheet is prepared to show the financial position of the limited company. So our appropriation account, as I said earlier, the appropriation account is prepared to determine the what, to determine the dividend to the shareholders, and also that is the proposed dividend to the shareholders, that is maybe ordinary shareholders or preference shareholders. And again, to determine to deduct the corporation tax from the profit of the organization, and also to calculate whether there is retained profit within a period, and also to make provision for reserve, whether capital reserve or revenue reserve. So all of these are made in the appropriation account. So let's take an illustration on the topic. So we have an example now, an illustration. So the following trial balance was accepted from the book of Biodun Nigeria Limited on 31st December 2004. Actually, 2004. So This is authorized and issued share capital. We have 20% ordinary shares of 1 each, which will give us 20,000 naira. 20,000 naira. 20,000 ordinary shares of 1 each, which give us 20,000 naira. Then 5,000 8% preference shares 1 each. That actually give us 5,000. 5,000 shares times 1, that gives 5,000. 20,000 times 1, that gives us 20,000. Then we have purchases, we have sales on trend, we have future balance, then all you do is the share premium, general reserves. So we should know the difference between the ordinary shares and the preferred shares. The ordinary shares are the real owner of the business. That is that the real owner, are the equity owner of the business, and they receive shares after the preferred shares have received their shares, and they do not have fixed rate of dividends in the period. While also the preference shares receive, they are the first person to receive dividend. They're the first class of shares to receive dividend before any other form of share, and also they have a fixed rate of dividends in the business. So their rate of dividend now is 8%, which I was giving. So we have purchases, we have sales, we have stock at 4th January, we have returns and all that details there, and we're giving additional information. We have stock, we have existing, and so on and so forth like that. So it will be advisable for you to write this question down, so it's displayed fully on your screen. So make sure you write it down, have it in written, so we can have the solution. You can follow in the solution. So make sure the question is written down. So you can do that. You can pause the video and write the question down, so we can have the solution on the board. The first thing is for us to mark those items we are going to need. So we're going to mark, you can start marking this, because this question we must have written this question down. So those items we need in the trading account. So you're going to mark the purchases. So mark the sales, stock at first, which is the opening stock, then the returns, you mark it, you're going to need that. Carriage inward, then carriage outward, you're going to mark that. And what other item do we need in our trading account? Okay. We don't have any other items again in trading account apart from the closing stock. Okay, apart from the closing stock. Okay, so let's go ahead. So we have sales, the amount of sales in the period. So the amount of sales in the period is 78,210. So let's return inward in the period. We're going to let's return inward in the period, and return inward in the period is the returns, the one at the debit. The one at the debit is this return inward in the period. So 320. So I'm going to let that to give us our less sales. So we have 0. So we have 9. So we have 8. We have 7. So we have 77,000. So we have 9, yeah, exactly 9. That will be 11, 8, yeah. So we are done with that. That gives us our net sales. The next thing is the opening stock in the period. So the opening stock in the period is 6,024. So we add our purchase. Our purchase in the period is 61,450. We had that. So I can have 47476. So we have carriage inward. We're going to add that to it. Carriage inward. So we have carriage inward in the period, which is actually 630. This is 30. 30 we have that will be 40186. So we have less return outward. That's our return outward, and our return outward is the 410. 410. Then we have 4. We have 9. And we have 6. We have 7. And we have 6. So cost of goods available for sales. So the next thing is to list our closing stock in the period. We're going to deduct our closing stock in the period. Let's closing stock. Closing stock in the period. So we have additional information. So we have 7,434. That will give us we have 0. That will give us 6. That will give us 2. 0, 6. So we have that as the cost of goods sold. So then we have our gross profit. So we can have a balance account. We get 77,819. And I give us 77,819. So you can have a balance account. You can subtract 77,890 minus 60,000. Okay, we have 77,890 minus 60,000, 260. So we have 17,630 as the net profit. 17,630 as the net profit. So the next thing is gross profit brought down. So we have 17,630 as gross profit brought down. Now the next thing is the list of expenses. So we're going to list all expenses in the period, all the expenses, and that's started from carriage outward. We have carriage outward. We have wages and salary. The next thing we have lighting in the period. Thereafter we have rates. We also have repairs and maintenance. Thereafter we have motor expenses. Thereafter we have discount allowed as the expenses in the period. Able to identify expenses. We have directors, social and expenses, remuneration. So we have also auditors remuneration. So next thing we have, okay, that is all about the expenses in the period. We have depreciation. We have to recognize depreciation in the period. So we have motor van. We have features and fittings. We also have office equipment. So let's have a list of expenses in the period. The first expense we have is carriage outward, which is 470. Is carriage outward, which is 470, and we don't have that in the additional information. We don't have anything as regard to carriage outward in the additional information, so we can have that 470. Next, in the wages and salary. Okay, we have wages and salary, which is 2,688. 2,688, and we have for some information on that. Wages owing, which is 112. We are going to add that. Do not forget the actual concept of accounting. So owing added, you have to consider as an expenses incurred. So we have the wages and salary, which is 2,688, and we also have wages owing in the additional information, which is 112. So wages owing. So if you can remember the accrual concept, which state that all of the expenses incurred in a particular period should be recognized in the profit and loss account. So it doesn't matter whether the expenses are being paid for or not. Since such an expenses has been incurred in that particular year or in that accounting period, such an expenses should be recognized into the profit and loss account or into the income statement. So since this wages has been incurred in this period, although it has not been paid for, so we have to what? Recognize such expenses in the profit and loss account. So we are going to add this now. So we have 0, so we have 8 and 2. So that gives us 2,800 as wages and salary. Now the next thing we have is lighting, and actually the amount of light is 730. Do we have any additional information about on lighting? No. We don't have any additional information on lighting. Lighting is 730. Now the next thing we have is rates, and rate is 1,200. Okay, and we told that rent is prepaid. Since this expense have been paid for as is not incurred in this period, we have to exclude this from the rates in the period. So we have a 0, that will be 6, that will be 9, so 960. So we have 960 as the rate that will be taken to us. So the expenses with the expense side of the profit and loss account. Now we have repairs and maintenance, and we can find that in the additional information. We can have it here now. So maintenance, repairs and maintenance, which is 648. And the next thing we have X motor expenses. We also don't have that in the additional information. So we have 2335 on that. 2335. Now featured all these are fixed assets. We don't need that here. Now discount allowed is 265. Discount allowed is 625. 625. Sorry, is 265. That is discount allowed, and we don't have it in additional information. We also have directors remuneration, which is 2,400. We have auditors remuneration, which is 320. So we also have depreciation motor van should be 25% on a reduced balance system. So we've done a reduced balance system. So motor van at cost, we've done depreciation. Motor van at cost is 4,000 naira. So accumulated depreciation before the year is 2,000 naira. So we are going to less that gives us 2,000 naira. Now depreciation for the year will then be, that is the net book value. Depreciation for the year will then be 2,000 naira times 25%. We are going to make depreciation now, and that will give us 25% of 2,000 naira. That will give us 500 naira. So 500 naira will be provided as depreciation in that year. So we have 500 naira for the period as net book value. So motor van, depreciation for motor van is 500 naira. Only with this balance system. Furniture, fixtures and furnitures, that will be fixtures and fittings rather. So fixtures and fittings, we have 10%. I'm very sure that was going to be on cost. So 8,000 naira. We have furniture and fittings. You're kidding me? Furniture and fittings, fixtures and fittings. Furniture and fittings. That will be the same thing. So that will be 10% times 10%. So we have that will be 800 naira. So we have 800. Now the next thing is we have is to provide for the position of office equipment, which is on cost Office equipment is 900. 900 times 10%. That gives us 90. That gives us 90. So office equipment 90. So now we have not provided for. In additional information, we have electricity bill outstanding. That will be also be provided for. So electricity bill. That means it has been incurred but not yet paid for. So we have to take that to the profit and loss account as an expense. So I'm taking the report to the balance sheet as a current liability. So I think we are done. The rest of information we have in the additional information go to the appropriation account. So we are done on this for now. We are done on this for now. All of the expenses have been included. Okay. First, calculate our net profit for the period. We are done on this for now. So calculate our net profits. Net profits. We have 470. All of the expenses 2,800. Then we have 730. We have 960 plus 648 plus 2335 plus 265 plus 2,400 plus 320 plus 500 plus 800 plus 90 plus 70. So we have 12,388. So I have a gross profit. So we don't have any other income. There's no any other income in the period, no any other income like discount received. Okay, we don't have any other income in the period. So what will happen? Net profit, the difference between the gross profit and the total expenses. So this minus this, that will give us 17,000 minus the total expenses. That gives us 5,242. So we have 17,630. We have 17,630. So we are done with the trading profits and loss account. The next thing is to prepare the appropriation account. Where you had everything there, that will give you total expenses. So the gross profit made in the trading activity of business is this. So for you to get the gross profit made from trading activity, we calculate our gross profit here. We are going to bring it down to this place. So this is the gross profit you have for the period. So all of the trading activities, all of the expenses made, being incurred in the period, you add everything up to this place. You understand? So you now find the difference between this and the total expenses. That will give you the net profit. So everything will balance. So now is the appropriation account. So we have the appropriation account. We have the appropriation account. So what are we going to have? We have profits and loss balance last year. Profits from last year, which is 2440. That's from last accounting period. So we have net profits made in the period. Net profit made in the period 5242. So what are we asked to make again? Okay, all of the required information that will come here. General reserve. Okay, give me the general reserve in the period. Okay, that goes to the what? To the reserve account. The reserve account. Okay. Okay. Transfer to general reserve. So we have to transfer 1,000 naira to general reserve. General reserve. We have 1,000 naira.
The next thing is provide for the final preference dividends. Okay, final preference dividends. Okay, we are giving that to 5,000 8% preference shares of 1 naira each. That will be 8% dividends is given to preference shareholders. How many number of shares? It's 5,000 shares, 5,000 naira. That will be the total amount of dividends to be declared on the number of shares. That will be 008 times 5,000 naira. So we have 400 naira as well as dividends. So preference dividends, that will be 400. So, and again, what information do we have? For recommended final ordinary dividends of 8%. So you have ordinary dividend of 8%. What is the ordinary shares? 20,000 naira. That will give us 0.08 and 20,000 naira. So that will be 1,600. That is 1,600 as dividend. So ordinary dividend will be declared 1,600 naira. So what other information do we have? Okay, corporation tax. Okay, they have to pay tax. That will also come here. 1,750 has the corporation tax in the period. 750 has the corporation tax in the period. So what again? What other information do we have? Okay, carry that word. We've used all those one. Of course, okay. Most of the expenses have been used. Discount allowed, used. Share premium, okay. Has been used. Okay. Has been used. Transfer has been used. Okay. We can then balance the account. So that will be profits retained in the period. That will be retained, profit retained, not distributed to shareholders. They can have a balance account. So I'm going to add everything here. That will give us 2,867. That will be 7,682. Supply everything there. So we have 1,000 plus 400 plus 1,600 plus 1,750. So we have 4,750 minus 7,082. So retained profit is 2,932. That will be retained profit for the period. So what is the next thing now? We have to do is the balance sheet. The next thing to do now to prepare is the balance sheet or the complaint balance sheet. As at 31st December 1990. Okay, that was 2004. So we have the fixed assets. So we can do it like this. All the list of fixed assets we have furniture, and fittings. So we can have we can do it like this. Okay, let's move it here. Fixed assets will be a better option. So we can have costs, we can have depreciation, then we can have net book value. We can have depreciation, we can even have cost in the period. So list of office assets, we have furniture and fittings, we have office equipment, so we have premises, and we have motor van. Okay. Provision for depreciation. We have okay, costs. What are the costs? We have 8,000 naira. We have 900 naira. So we have 15,000 naira. So we have 4,000 naira. So depreciation for the period, accumulated depreciation. Accumulated depreciation for the period. So we have 3,000 naira for furniture and fitting as the accumulated depreciation before, and the depreciation made now 800 naira. 800 naira. That will be 3,800 naira. So we have 3,800 naira. So the next thing is accumulated depreciation for office equipment. We have 250 before. So plus office equipment, what is depreciation made for office equipment? 19 naira. That will now be 340. 340, okay. Office equipment 340. So premises, I think there's no depreciation for that. There's no depreciation for that. Then motor van. Motor van, we have 2,000 naira before as the accumulated depreciation. Plus new provision made, which is motor van 500 naira. That gives us 2,500 naira. 2,500 naira. So that value we are going to have 4,200 here. Here we are going to have 560. Here we are going to have 15,000 naira. And here we are going to have 1,500. 1,500. So we can add everything together in this balance. This is a balance figure. So we can add everything here. And therefore add everything. We have 4,200 plus 560 plus 15,000 naira plus 1,500. Then we have 21,260. So we can have our current asset. Our current asset in the period. So we can have our current assets. Our current assets includes in the period, our current assets include stock. In the period, we have stock, which is 7,434. Okay. We have debtors. Debtors, which is 9050. So we have cash at bank, which is 1,000 there. So we have rent prepaid within a period. We have rent prepaid within a period. So we have 240. Rent prepaid within a period. Okay. We have rent prepaid during the period 240, and then what again do we have? As our current assets, debtors, cash at bank has been there. Okay, I've given the cash at bank is there, so we have the debtors is there. What again? I think we have any other thing again. So I think that is all on our current assets. That is all on our current assets. So I didn't have add everything together. Add everything together. We have 7434 plus 9050. You can at least write it here. To avoid confusion, I write it here 7434
9050, 1000 naira, and 240. To make our work neater, we can write it there. Still the same thing. So we have 7434, 9050, 1000 naira, 240. So that gave us 17,724. 17,724. So we can prepare our owner securities and all of the rest of the accounts. Can prepare the owner securities. So next thing we have authorized and issued capital. Authorized and issued capital. So we have ordinary preferred shares. Ordinary shares. Ordinary shares whose value is 20,000 naira. Then we have preferred shares. 8% preferred shares. Preference shares, which gave us 5,000 naira. That gives us 25,000 naira. So we can have reserves in the period. Reserves. So all of the reserves includes, we have share premium is a reserve. Share premium in the period. That gave us 2,000 naira. We also have general reserves. General reserve. And we are told that 1,000 naira should be transferred. We have 2,000 naira before, and we are told that 1,000 naira should be transferred to general reserve. That will become 3,000 naira now. So because we have great provision for that in our appropriation account. So we have corporation tax. Corporation tax paid for. How much is that? 1,750. So what again do we have? So do you have any other details as regards to reserves in the period? I don't think so. I have any details as regards to reserves. If you don't have any other details, share premium. Okay, we don't have general reserves. So we don't have any details as regards to reserves. So we can add everything. So we therefore had everything. We have 2,000 naira plus 3,000 plus 1,750. So we have 6,750. So we have liabilities. Do you have any long-term liabilities? I don't think so. We don't have debentures. We don't have none. Okay, we don't have any liabilities. We don't have any liabilities. Okay, interesting. We don't have any liabilities. So we don't have any long-term liabilities rather. So let's talk about the current liabilities in the period. Current liabilities. We don't have long-term liabilities rather. So we have current liabilities. Okay. So we have the creditors. The balance of creditors is 2120, and again we have unprepaid dividends that have not been paid for. Preference dividends, since it just declared it has not been paid for, we have 400. We also have ordinary dividends. Which is 1,600. There also we have wages owing, that is accrued. We have accrued, we have wages, and we have electricity.
So we have wages is actually 112, and electricity is 70. I think that is all about that. So we can balance our accounts. So we've done corporation tax, we've done all of this. So that is all about the accounts. Let's have a balance account now. So we have 2120 plus 400 down 600 112 70. So we have 4,302. So we can have a balance account. No stress. Okay, what is the total of this? That is 1,260 plus 17,724. I give us 8,984. So we can add everything here. We have 25,000 naira. So we have reserve, which is 26,750 plus 4,302. Wow, interesting. We have 7434 plus 9050 plus 1,000 naira plus 240. So we have 17 exactly plus 21,260. So we have 38 exactly. Okay, so 25 4. Okay, 84. 25,000 plus 6750 plus 4302. Actually, 984. Okay. Oh, retain profit. What kind of error is this? Oh, what kind of error is this? Retain profit is part of the reserves. Wow. Retain profits. Wow. It's part of the reserves. I'm looking at this. 2932. Come on. What kind of error is that? It's part of the reserves. Retain profit for the year. That goes to reserves. So Peter, you have 2,000 naira. So you have to calm yourself by doing that. Retain profit is part of the reserves in the period. Plus 3,000 plus 1,750 plus 2,930. 932 rather. So we should have 9,682. So that is the error we made. You know, when profit is being made in the period, profit had to be added to capital if other is what sole proprietorship. So we have a profit. Why are we not going to add this to that? So retain profit form part of the reserves in the period that is not distributed to what to shareholder for dividend. So now we can have a balance account now. We can have 25,000 naira. That's the error we made. Plus 4302. So we have 38,984. So that is all about the company's accounts. It has been an interesting topic, an interesting one with you people. So you can check around with the question. Just check around with the solutions. Move around, you can just check right from the trading profit and loss account up to the appropriation account and up to the balance sheet of the company. So you can move around with it. Here it's actually 240. And move it down to 40, then we have 17,724. So you can just go around with the solution. And do not forget the retain profit form part of the reserves of the organization. So we've done much about the company's accounts. We talk about the meaning of companies. We look at the kinds of companies. We look at types of companies. We also talked about the what again do we talk about? We talk about accounting prepared by the accounts, book of account of the of the limited liability company,
Yeah, oh, okay. We talk about the share capital. Yeah, exactly. Maybe we talk about the cut-off capital, the issued capital. Also talk about the authorized or the registered capital. And again, if you're having confusion as regard to the topic, what are the questions? So please, you can just do well to replay the video. And again, some exercises will be displayed on your screen as regard to these topics. Please do not hesitate in attempting such question for better understanding. Thank you very much.